G'day, welcome to Lunch Money. We are the online and social media home for workouts, special situations and capital raising professionals. My name is Nick Samios. I'm the Director and Fund Manager here at Hermes Capital and I'm your Lunch Money host. So a very warm welcome to you. Our humble podcast comes to you from Waterloo, which is in the south of Sydney. These days, Waterloo is a mess of apartment blocks up and down Botany Road here, brand new apartment blocks. And that's great because building apartment blocks, that's construction, and construction creates jobs. But many years ago, when I started in finance, this area, Waterloo and South Sydney, was factories from Surrey Hills through to where I am now, all the way to Mascot and beyond. And all those factories, as someone selling finance, in my time, you needed to know the language of the rag trade, or schmutters, as some of my clients used to call it. You needed to know the difference between a blow moulder and an injection moulder in the plastics industry. You needed to know all about pre-press when it came to the printing sector. And you needed to know about the economics of buying a new CNC machining machine for your manufacturing client that was making components, and you'd be able to do the calculations on how this new machine was going to pay for itself. And like I say, these manufacturing created jobs, of course, and it gave us a certain self-sufficiency that we didn't realise it had been denuded of really until COVID came along. Recently, the Prime Minister has announced a program. It's going to be a $1.5 billion program called the Modern Manufacturing Strategy. So today we're going to ask, how do we grow, foster, nurture manufacturing in this country, and how do we make sure that our manufacturers are well funded in order to take on the challenges that our government seems to be setting them. So coming up, I've got David Gandolfo, who is the president of the Commercial Asset Finance Brokers Association, and Gary Tesher, who is an investor and consultant to the manufacturing sector. Just before we go any further, I'd like to remind you to share, like, and to subscribe to our podcast. Just a reminder also that you can ask questions live, and the best question wins this, the Lunch Money mug, very exclusive and limited edition. So pop us a question, we'll put it to our panel, and if you ask the best question, we've got you the mug. Before I go to our panel, I'd like to bring on another speaker, Tony Sykes. Tony is the owner of General Insurance Brokers of Australia. Tony published an article this week that caught my eye called Protect Your Manufacturing Business from These Important Risks. Tony couldn't join us live today, but he was able to take a few minutes to talk us through some of the points in that article. Of particular interest, a couple of little things that he said that I did drag out of him was whether or not business or COVID is an insurable event as a business interruption, and you'll see what he says to that. Something else he said that I thought was interesting was that because the insurance companies are getting very low investment returns at the moment, it makes getting cover for manufacturers a lot harder. It's a lot. They've tightened down a lot. Let's take a look. And here he is. G'day, Tony.
Hello, Nick. How are you?
Very good indeed. Listen, before we get on to the article itself, what's happening in the insurance space when it comes to manufacturing?
It's a good question. So at the moment, what we're finding with the insurers is that their risk appetite is under attack. So they can only insure manufacturers who actually take their risk and their risk management correctly and does the right thing as far as risk management.
Okay. All right. So it's a time when you've got to be dotting your I's and crossing your T's and talking to people like yourself, no doubt. I've always thought that if you're buying a business, a good place, or if you're buying a business or starting a business, a good place to start is with an insurance broker, even before you do your business plan. And the reason I've thought that is because you guys identify insurable risks and you list insurable risks. And often, I know even in my business, the insurers identify stuff that we hadn't thought about, but we're certainly very glad they told us about them. Here's a list of the risks that you've identified in the manufacturing space. Do any of these stand out in particular when it comes to rebooting manufacturing in Australia?
Oh, look, I think the main one that's there is the business interruption cover. we need to protect their gross profits in the event of things happening. So with manufacturing, it can be a high risk area, and when things do go wrong, e.g. a storm, a fire, or malicious damage, it's not just a matter of them buying a new laptop and getting up and going again. They actually need to have proper insurance to protect their loss of gross profits so they can actually get back to business again.
And dare I ask, was COVID an insurable risk when it came to business interruption?
It's a really good question. It was not, in my opinion, right? It was not an intended insured event under the policies. However, there were some technicalities where the Quarantine Act's wording was changed, and some of the policies technically weren't worded correctly and were providing the cover. But it's been tested by the Insurance Council of Australia, and it looks like the insurers are actually winning that fight, because it's pretty obvious the intention was not there for a pandemic event to be covered under business policies. Certainly under corporate travels, but not under business policies.
When do they make that decision? When do we find out?
In fact, it's just being tested at the moment. So I think it's only a matter of weeks where we'll get something probably from, I think it's from the Insurance Council of Australia, to let us know how that's going to go.
So I've got a couple of experts coming on very shortly tomorrow, your time, to talk about finance and strategy when it comes to rebooting manufacturing in Australia. Is there anything on that list, anything else on that list that stands out that you think I should be putting to the boys?
Absolutely. So there's the product and public liability insurance. Your customers aren't going to deal with you as a manufacturer unless you can produce certificate of currencies for your public and product liability. The landlord's not going to let you lease premises unless you can produce certificate of currencies for your public liability. And what you mentioned before about using a broker early in the piece is a great idea, especially in this market, because it's a limited market. Insurers are picking what they are insuring because they don't have the investment incomes. So therefore, they've got to make sure that their underwriting profits are bang on. It takes time to get quotes.
Well, I can tell you, particularly when you're capital raising, your potential investors may think of risks that you don't think of on your own, and those risks are certainly the ones that insurers have thought of. So that's why I think those lists that you provide are really good. Listen, Tony, I really appreciate your time. Hopefully we can get you back as a panellist when you don't have international conference calls to do.
Absolute pleasure, Nick. Nice to help, buddy.
Thanks a lot.
Take care. Bye-bye.
Okay, time to introduce our panellists, and we'll start with David Gandolfo.
Hey, Nick.
Hello, David. How are you going? Very good. Excellent indeed. Thank you very much for joining us again. David is a director at Quantum Business Finance, so he's a practicing broker, but he's also the president of the Commercial Asset Finance Brokers Association. What has been keeping you busy?
Okay, over the last few weeks, we had the federal budget, and we had some input into some of the policies and outcomes that came out of there. So, and then dealing with queries which have arisen from that. So that's been good, and quite overall happy with the federal budget and what it provided. In Victoria, and I'm Victorian based, we have a lot of members who are Victorian based. We've been dealing, we are actually on a consultation group with the state government, and there's been a lot in the media about the level of consultation from the Victorian government. I've got to say, it hasn't quite been what it has been in other states, but at least we're at the table and having an interaction with the government there. And the other thing which I'm very happy to talk about is the CAFTA Education Foundation, which had its first formal meeting this week. It's chaired by Terry Moody, who I know you know very well, Nick. And the CAFTA Education Foundation is the formalisation of our partnership with lenders and other stakeholders in the industry to Australianise the CLFP, which is an international qualification. That's its first task, but it will underpin all of the efforts of education around commercial finance, commercial and asset finance in Australia.
And I know that you've had a lot of battles that you've had to fight from time to time. CAFPA's had battles, and I know that, for example, one of the areas of concern was the responsible lending obligations, because whilst they were intended for consumers, they did leak across into the thinking when it came to business lending. Are there any other battles that you've got in front of you, or is it all plain sailing at the moment?
No, it's been an interesting year, and there's certainly been plenty to do. I mean, whilst there hasn't been quite as much business going on, there's been a lot in the advocacy space for us to deal with. So access to credit, tightening of lending policies by lenders, that sort of migration of lending from the first tiers and the broadening of the base of the second tiers, or the appetite of the second tier lenders. Regulation, obviously, the outcome there with responsible lending guidelines, and we certainly had a role in that, and we were very vocal in that space. Our submission, as I said, to budget, to the federal budget, and the outcomes there, we're very, very happy with the instant asset write-off, but there are some limitations on that which we still weren't thrilled about. So there's been no shortage of things that we've been dealing with over the course of the last 12 months, or since February.
All right. Well, look, David, we're going to pop you back into the waiting room. We'll just introduce our next guest, Gary Tesher. G'day, Gary. How are you?
Good, Nick. How are you?
Fantastic. Gary is a partner at ProMentor, and I guess I know Gary as a consultant who gets involved in turning businesses around, helping businesses move from distress to a better place. But I know that you've been an investor in manufacturing businesses in the past. But tell me, what keeps you busy these days, Gary?
There's two things that keep us busy. One is the kickstarting of manufacturing. It seems from our experience that not a lot of people know exactly what needs to be done. Certainly, we're working at the moment with the Commonwealth Government trying to figure out how to kickstart manufacturing. An interesting comment that they made when they spoke to us was they didn't think there were too many manufacturing people left, and also they didn't believe that there were too many consultants left, or advisors, or people who've been in manufacturing in the real world in the past that can help them figure out what to do. So we're going to go through a little bit of a process today as to how to do it, or what our ideas are, and how we're going to help manufacturers get back on their feet again. The other part that's kept us busy is the banks. At the moment, the banks are being really good in terms of industry in general. What they're doing is they're giving people interest holidays, capitalising interest if they need to. In terms of principal repayments, they're giving companies holidays for principal repayments as well. And on top of that, a couple of the banks are now looking at extending that for the next 12 months, as long as the businesses show that at the end of the 12 months, they can turn themselves around and make real money again. But the general thesis is that banks don't want to see people thrown out of work or added to the unemployment queues.
So do you think the banks are on a mission to make this softer? What are they expecting come the new year? Are they expecting a wall of insolvency, or are they expecting just everything to be kicked along and smoothed out? What are they telling you in the workout areas?
In the workout areas, what they're expecting is very small businesses, so 1 or 2 or 3 man businesses. They're expecting to fall apart, but they're expecting larger businesses to somehow figure out how to get themselves out of trouble. And certainly, the banks, from what we see, will actively help them. One of the banks is setting up a little team to help advise SMEs, so medium-sized companies, what they need to do to dig themselves out of a hole. And I haven't seen that done before, not for a long time in the past.
And so if for our insolvency practitioner viewers, are they going to be busy early in the new year, or are they getting their hopes too high?
Well, that's a very good question, actually. I think if the insolvency practitioners have got very low overheads and they can do very small businesses, small to medium businesses as a process, they'll probably do well because they'll be small companies. I think the medium to large companies, I think what banks and others will expect them to do is figure out how to restructure them. But I don't think they'll actually be putting them into receivership or anything like that. So it'll be more like an administration restructure, come out of administration in a different format. I think that's how it's going to pan out. Okay.
All right. Well, look, we'll bring David back. And I should say I've had one question from an anonymous LinkedIn person who has asked, where was the mug manufactured? And I'm probably ashamed to say, I don't know. I assume not Australia, but if someone can put me onto an Australian mug manufacturer, I will give them our next order, I promise you. Okay. All right. Well, look, now, Gary, you've been working on some stuff, and I'm not sure what you can tell us and what you can't tell us. Why don't you tell us what you've been up to?
In terms of the manufacturing or kickstarting manufacturing, I think the fundamental problem and David alluded to that a little bit, is that handing out grants and doing a lot of tax deductions or whatever doesn't necessarily do the job. The reality is that there's more bits to the equation than that. So, for example, in a manufacturing business, certainly they're not going to spend a lot of money buying some new equipment if they can't see sales or if they can't see any advantage in it. There's just no point. They might get tax deduction, but if they're not paying much tax anyway, there's no upside for them as far as that's concerned. So that's one part of the equation. So what we're looking at is more looking at, first of all, import replacement. So say, for example, somebody makes a component, they make a component locally in Australia, a circuit board or whatever, and then they import a plastic housing or a plastic part that goes around that. So what we do is look for somebody who can make that plastic housing in Australia and say, look, you guys need to work together, and that way that'll generate some extra sales for the plastic housing guy and vice versa. So the idea is to look at areas, say industrial areas where there's a lot of small to medium-sized manufacturers, and get them to help to work together with each other. The other part of the equation, which is what we'll be doing, is sales. As I said, sales, if you haven't got sales, you're not going to spend any money on anything and you're not going to generate any employment. So the other part is we have spoken to a few of the very large retailers, and they're prepared to support Australian manufacturers or import replacement as long as it's no more than 10 to 15% more expensive than what it is locally for the imported product, and they're prepared then to generate some extra sales.
Well, that's interesting. I remember when was it SPC, the fruit cannery, were getting into trouble, and then Woolies stepped in and bought lots more of their product, and there was lots more on the shelves. So I understand that. Now, Gary, you have done some specific work that we'll come to in a moment, but just David, when I think about what the government can do to try and support manufacturing, there is this green program, green leasing, or what's that green finance incentive? What's that? Do you know what I'm talking about?
Well, there are through the Clean Energy Finance Corporation, there are some subsidised finance facilities which are available for efficient assets. Primarily, they're attached to motor vehicle finance, and if there's a subsidy that goes in there, which makes the loan 0.7% cheaper if the motor vehicle is energy efficient. And almost all motor vehicles that are new fall into that category. Although you would be surprised that some purely electrical vehicles actually don't. So there's a list of vehicles that do and don't. And the CEFC it puts money in tranches into banks and financiers to be lent in that way. I'm assuming that's what you're alluding to.
Yeah. And is that a mechanism that works? I mean, is that an effective mechanism, and is that something that could be applied somehow
in reality, all it becomes is a price mechanism, because the customer is ultimately unconcerned with how the wholesale funding arrangements work, and they still shop on the basis of price. So it's a market advantage for some lenders to be able to offer that product or something similar to it. And I'm aware of one lender who actually doesn't get its funding from the CEFC, but does something off their own back in order to compete with it. But it ultimately just comes down to a pricing advantage. And the SME G2 loans, which have the government guarantee, have got an element of that in them as well.
Right. Okay. All right. Now, Gary, you showed us some work that you're doing. That you've been commissioned to look into this manufacturing sector at a government level.
Yeah.
And we'll just show some workings that you've got there. So, do you just want to talk us through this? What this is all about?
Yeah, sure. Well, as a starting point, I guess I should say, the interesting point is the federal government seems to be far more interested in kickstarting manufacturing than the state government, which I think something that also David mentioned. So the federal government is trying to figure out what to do. So what we're going to do is set up little hubs. The problem in the past is that there's been a lot of reports written about how to kickstart manufacturing. Most of them are basically reports. They talk about what happens overseas, they talk about what happens locally, but they don't actually tell you how to do it. The reason that they approached us was because they want a group of people who've actually done it all before and want to figure out how to actually get things moving. So what we'll be doing is looking at regions. So the regions will be in Victoria and New South Wales. there'll be areas where there might be 30 or 40 manufacturers to start with, and then what we'll be looking at ways that we can make them work together, make them buy from each other, and ultimately also make them look at transport, make them look at outlets for sales, for selling, and that way, hopefully, we should be able to generate more employment. People that are involved in our group also are one of the very largest, I guess, not-for-profit organisations. They're funded by the government. They help NDIS, so we'll be looking at what sort of other people that we can put in which may have mental disabilities or people that have been long-term unemployed as to what we can do to help them work in some of these areas. And that's one of the groups. Another group is that we've got one of the universities in New South Wales and two of the universities in Victoria, again, looking at products that these guys have developed, the universities have developed, trying to steer them into products that will actually add value to the manufacturing businesses that we've got so that we know they can actually create extra value, extra sales, and we'll be getting them together. There will be some government money available to help kickstart that as well in terms of commercialising products that they've developed.
Right.
And then we've done deals with retailers. So these are very large retailers, they're national retailers, and they're happy to put products on the shelf and to support Australian manufacturers. In one instance, I can't say who, but one of the large retailers has already helped us on a project we're doing at the moment for a bank. So it's a manufacturer in Victoria, and they've probably added about 40% sales to this particular company, which has caused them to employ a lot more people and made them a lot more financially stable than what they were in the past. So the little trials that we're doing seem to be working.
Okay, well, that's fantastic. And I noticed you've got. So did you say the bank was involved there?
Yeah. So the banks are very patient at the moment. A couple of the clients involved in this process, needless to say, are in the workout area. But the banks have been very supportive in the sense that they haven't demanded all the usual rules that they have in terms of payback of core debt and so on. They've taken holidays on that. And also, a couple of instances, they haven't asked for interest repayments either. So they've been prepared to capitalise the interest, particularly when we started growing the businesses because we were short of cash. Right. So they have been very helpful. It seems like that's generally the trend at the moment. But some are probably more helpful than others, but we can't say who.
All right. Any thoughts there, David, from your sort of perspective as CAFPA or even COSBOA?
I think that's true, and certainly at the senior levels of the bank, the intention is there to assist business and manufacturing as much as they possibly can. In the SME part of the market, where lending is a lot more commoditised, it's a lot harder to get the banks to create a rule or to individualise solutions for industries or for clients. But they certainly, I take your point that they've been very, very good with capitalising interest repayments and with deferring loan repayments, and there is a scheme to continue to do that without it having any impact on your credit score or your credit rating. What worries me, one of the things that concerns me, is that 12, 18 months, 2 years from now, the banks will be looking back at this period of time and saying, well, hang on, you were in deferral at the time. What was the problem? Notwithstanding that people will have traded their way through and things will have improved. But I actually have a question there for Gary, just following on from one of the points that you've made. What about apprenticeships and the government incentive there to subsidise apprenticeships? Do you think that will have a dovetailing effect into the capacity to actually manufacture? Because I know that a lot of our clients in manufacturing are saying that they can't always get people to do the jobs that they need.
Yeah, that's fair call. Certainly with apprenticeships, we're going to give it a try. We're involved with 3 manufacturing companies at the moment, so we're going to try and put some apprentices in. One of the groups that we're involved with, one of their jobs is to place apprentices. They're funded by the government, so we're going to try with electrical apprentices, particularly, and fitters and turners. We'll see what happens.
I guess a couple of we've got one of our viewers asked the question. Are we going to sort of see more of the Buy Australian campaigns, and does that sort of thing work, or are we sort of a little bit more sophisticated than that?
Yeah, look, it's a very interesting question, actually. What we found with 2 manufacturers that we're working with at the moment is that when their sales were okay, then we put Australian made stickers on them, and their sales probably went up by about 25 or 30%. Right now, the sentiment in Australia seems to be, with retailers in particular or more expensive products, they will buy Australian. And if it's got a made in China sticker, they're not interested no matter how cheap it is, it seems.
Wow.
That's generally the sentiment we're seeing right now. How long that lasts for, I don't know, but that's the sentiment right now.
25%.
Yeah, in both cases.
That is impressive. Now, David, I'll ask you. Back when we were lads, there was a thing called the button car plan. We won't go into the minutiae of that, but they did try to sort of dictate to the auto industry to consolidate the number of models, et cetera, et cetera. And we always hear about governments trying to pick winners. Do you think this new program, they've narrowed it down to 6 industries? Is this a case of picking winners, or is it a little bit more sophisticated than that? Or what are your thoughts on that generally?
Oh, no, I think that's probably the right plan. I mean, it's probably a very, very good starting point. And then, water finds its own course. I mean, we have a lot of clients, and our experience has been that manufacturers in one industry will create work around for other industries that are sort of ancillary or that are around them. So I think you've always got to have a starting point. And if you can localise or identify where the best sort of routes are to plant those seeds in the manufacturing sector, then I think that's a very, very good strategy. So it certainly seems to work. Going back to your point, Nick, about the button car plan, and when you and I know each other for a long time, when we were first in this business, in terms of funding of equipment, there's still tons of equipment that's being financed. But there's very little of it which is Australian. There's very few large manufacturing pieces of equipment that are Australian made, but people do tend to gravitate towards them because they know that they're good quality. And particularly, and I'll take Gary's point about China, the very, very few of our clients opt for Chinese equipment, especially for a second time.
Gary, I just wonder, when it comes to the sort of strategizing that you've been doing and advising the government on, there has been criticism of this, of the Prime Minister's plan, and I guess a little bit of it is political, but suggesting that, well, if you're encouraging manufacturing, all the heavy equipment, the lathes and the machines and whatever it is, the manufacturing gear, it all comes from overseas anyway. So all you're doing is sending the money overseas. I mean, do you buy into that, or is that just short-sighted?
That's just short-sighted.
And can I ask, is it part of your plan to actually manufacture the machines here?
Well, that's a two-edged sword. The first question, I guess, in terms of the manufactured components, one of the projects that we were involved with about 2 years ago was to have the trains locally manufactured. So in Victoria, about 70% or 72% of the components that go into the high-capacity trains, and about 80%, I think, on the trams, are all made locally. So you're right, some of the lathes and some of the equipment that was needed was imported. But the reality is, at the end of the day, that generated a hell of a lot of jobs in terms of people operating the machines. So the machine cost was very small. In terms of getting machinery done, we've done it a little bit differently. We're involved in quite a lot of high-tech medical products at the moment. So I guess that's equivalent to what you're talking about, machines, which will be made in Australia.
Right.
So, but in terms of the equipment that's made from overseas that's imported, they're made by people who've made it for a long, long time and have spent billions of dollars literally on R&D, and to replicate that in Australia with small populations, not economic.
Can I just say something there? I mean, if you import one piece of machinery into Australia, the money goes overseas, but then that piece of equipment manufactures a whole lot of widgets or whatever it is that it makes, and is part of the manufacturing process, or part of that whole train of events, then the fact that the initial machine has come from overseas is not such a bad thing. It was producing assets here in Australia.
And David, you were before we went live, you were saying that maybe one of the shortcomings of the instant asset write-off, it biases against existing equipment.
The point I was making there is, and I'm very, very happy with the instant asset write-off and with the fiscal policies that the government has adapted. There's very, very little that you can do with monetary policy when rates are 0.25%. But tax treatment does drive behaviour. Now, we know, and you only need to look at last June, there was a run-up and we were run off our feet. It's the only time of the year that we've been busy, but we were run off our feet getting things settled before the end of June, so that people could get that deduction into that financial year. Now, with the extension of the instant asset write-off, There's no limit to the value of equipment. It goes to 2022. There are some limitations in terms of size and turnover of business. But one of the things that has come out of it is that second-hand equipment up to $150,000 can only be deducted up to $150,000 up until the end of December of this year. And our point to that is that there's a lot of second-hand machinery which is already in Australia and available to be used here that can pump out widgets and produce components. Now, why devalue that equipment and disincentivise people to buy that in place of much more expensive new equipment, which comes largely from overseas?
Right.
So that's my only criticism of it.
Right, yeah, and thereby sort of negating this concept of the money going offshore as well, I suppose.
Mm.
David,
Yeah.
Are there any sort of special challenges to financing manufacturing equipment? I mean, I guess superficially and obviously it's a lot easier to get anything on wheels financed rather than something that sits on an industrial floor. Is that still the case?
Well, I mean, I know that there's a lot of enthusiasm for the banking sector, and I think the ABA and the banks have done a great job, particularly given the oversight that they've had from APRA and AFCA and ASIC. And I'm delighted that those rules around responsible lending are going to loosen up a little bit next year, and it is next year. But it's still the problem still exists that a lot of lending is commoditised, and that specific projects and individual circumstances are hard to fit into that sort of streamlined lending process. So that gives rise into that second tier of lenders which have come into the market. And the one thing I would say to any prospective customers who are looking at buying new equipment, if their own bank can't hurt, and to Tony's point very early on in the piece when he was recorded, brokers in this market are very, very good at finding the solution where there's a whole lot of options out there, but not all of them will suit your circumstances.
I've been in finance for a long time, and I reckon that I know a hell of a lot about finance, and I certainly use a broker, for example, for my home loan. If you get me to talk directly to a bank, you've got to be kidding.
What I'd say to customers there is that if your own bank can't assist you, or if traditional sources of first-tier funding aren't available to you, and if you have to go to a second-tier lender or to a fintech or somebody else, and if perhaps you might be paying more, what's the cost of not acquiring that asset against the cost of that extra, 2 or 3 percentage points of interest that you might be paying? So, and that I think is a very, very important point. We're saying that interest rates are traditionally the lowest that they've ever been. The reality is that a lot of people aren't getting what they need at those types of rates, but they're still utilising finance facilities to get what it is that they need to put on their factory floor to increase their capacity to double their throughput.
I'll tell you, one of the you make a good point. So one of the interesting things that Tony Sykes said in passing, it wasn't sort of his key point, but was that because insurers are getting very low investment returns, it means that their underwriting has to be that much more profitable. And it's tightening up on the insurance that's available to manufacturers. And I wonder if that's an obstacle. I don't want to go down that path just at the moment because we are running out of time. Gary, when it comes to capital raising, I mean, are you seeing that capital raising is a particular challenge for the manufacturing sector in kickstarting it again?
It depends if it's in quote unquote a glamour industry. If it's in a glamour industry, which means, for example, there's one that we're involved with, they developed an X-ray machine, you walk into it and about 20 seconds later you've got a full X-ray of your lungs and all the rest of it, which doesn't exist up until now, so you can pick up COVID and all this. They raised $250 million basically on a prototype, which on the ASX, which is absolutely amazing. There's other companies that we're involved with which make general widgets, I suppose is the best way to describe it. They make money. They've made money for quite a few years. They're looking at expanding. They're having difficulty. So it seems to me that if it's a glamour industry, you've got no problem at all, i.e. IT or medical. If it's just a regular run-of-the-mill type manufacturing business, it becomes difficult. That's what we're saying. Okay.
Well, look, we are running out of time, so I'll just go to you for some closing thoughts. David, I'll go to you first.
Yeah, well, look, I think we're going to find our way out of this situation. The Victorian situation at the moment is not, and I'd say to people in Victoria, it's not like this in the rest of the country. And I know that we've got a lot of clients who are itching for the restrictions to ease. And as soon as that's available, we've got a lot of pent up demand, and that demand will be realised. So we've got a lot of finance facilities that we're putting in place at the moment. People are deferring, actually settling on those and taking delivery of assets. But as soon as they're able to get out there and actually manufacture and get back to a normal kind of working environment, I think the economy will go fairly well, fairly quickly.
All right, well, hopefully we'll have a bit of a slingshot effect. Gary?
Yeah, I agree with David. Certainly what we're saying is exactly the same. We're also seeing that, very interestingly, quite a few manufacturers have approached us to help them set up in Australia. One is a very large pharmaceutical company. The reason for that is that they've got large facilities at the moment in China. It's a US mob. They want to pull out of China completely, and they see Australia as a safe haven to make a lot of the product for the Asian market. So again, I agree with that. Once we start to move around, then I think you'll find that there'll be a kickstart in terms of getting other products made here, which will create employment.
Well, that is interesting, Gary, because if they're moving, I know that part of the US strategy is to shift the supply chain out of China, and I always thought they'll look to shift into Southeast Asia. But you're thinking that Australia might pick up some of that as well.
Well, we've certainly been approached. Yeah, one of the same question as I asked the guys in the US, and their view on life is that at the end of the day, Vietnam, which is the favourite place at the moment, they're concerned about the political stability, and they're also concerned about the cost. They've worked out that even though the labour costs are low, the infrastructure at the moment is really bad in terms of electricity supply and roads and so on. So to get product to ports and so on is quite difficult. They prefer Australia, where at least it's pretty straightforward. And the other important point, I think, is that on average, probably about 8% of your costs are labour costs. The rest is automation, equipment, and so on. So if you're looking at an 8% direct labour cost or 7% direct labour cost, it really makes no difference to your price, but it's safer to make the product here.
Well, the other thing too is, I mean, some people might be thinking, oh yeah, but I mean, that's a US company coming to Australia, and but the thing is, it might be some great big plant that's American owned, but they're still going to need locally made components. Maybe there'll be some packaging, local packaging. Of course, the stuff needs to be moved around on the local trucks, et cetera, et cetera. Listen, Gary, you say that
they employ a lot of people as well. So that's
that's it. That's the game. That's the game.
Right. But they don't just employ people; they also employ a lot of subcontractors, and people need to service that air conditioner and all the other little components that get manufactured. So, Gary, thank you very much for serving up that little gold nugget right at the end, because that's a really interesting line of thought. And thank you for introducing it. Thank you very much, David Gandolfo and Gary Tesher, for joining us on Lunch Money. Really appreciate your input.
Pleasure always. Thanks very much, Nick.
Thanks very much, Nick.
To our viewers and listeners, and I look forward to doing it all again next week. Cheers.